Good evening, everyone, and welcome to tonight's Forward Thinking Trader session. This is part one. The topic is a modern approach to technical trading, and my name's Karen. So everyone, before we get started, I just want to make sure you can hear me all right. So if you can hear my voice coming over your speakers or through the VoIP, please just let me know by dropping a Y or a yes in the chat box. Now that chat box is also going to be how you interact with me tonight. If you do have any questions or if you want to clarify the points, feel free to type your query into that chat box and send it over. I will be taking a regular pause for questions, and there'll be a formal sort of 5 minutes at the end where I'm happy to answer anything that you feel I have missed. We do have an ambitious schedule tonight, so we'll be spending about 2 hours talking about technical analysis and trend trading. I'll also be showing you some live examples on the platform itself. So if at any point along the way you want to take a pause for questions or you're not really sure, do clarify and interact with me. You need to get value out of the session, basically. All right, cool. Thanks, guys, for responding. So before we get started in the material, I just want to kind of talk you through the session tonight. So we're going to learn to think in probabilities, and I'm not sure if all of you are new to trading, but there's just a little bit of a risk warning and a disclaimer that I have to draw your attention to. Most of the Forex trades we'll be looking at will be leveraged, and leverage trading is not for everyone. So if you are new and you're not quite sure how this fits into your financial plan, do consult your financial advisor to make sure that it is for you. We have not considered your risk objectives, and all of the examples we're going to be talking about tonight are for educational purposes. Please do not take it as an inducement to trade. So I come from a company called Trade with Precision. We run the education programs for OANDA, and we are a group of private professional traders who trade either part-time or full-time for a living. So we've got a heftier disclaimer, but basically it says the same thing as the OANDA one. We will be looking at examples. They are for illustrative purposes. If you're not sure, consult your financial advisor. And if you want to read more about the legalese, just jump on the website there. It's tradewithprecision.com/legal. Alrighty, so what are we going to look at in the next 2 hours? So the agenda for tonight is to introduce you to textbook trades. So these are the classic trades to give you a very clear idea of what you're here to learn. We're going to look at price action. So that means chart structure, trends, candlesticks. What do we mean by an optimal chart structure and how you can use that in your trading? Ultimately, the goal is to get you thinking like a trader. That means to think in terms of probabilities, not in terms of dollar value losses or profits. I will get you guys thinking about the practical side of things. So there will be examples. I want you to start building your trading checklists just to give you an idea of the steps that you might want to go through as you trade. And we'll wrap it up with a live platform demonstration, which consists of me taking you through some charts for 10 minutes and showing you how to actually use that platform to place trades. So do we have any questions at this point about what we're going to cover? Yep, just so you know, this session is recorded. But if you're already in the session, then I do suggest you stay on board because you get to ask me questions. If you're listening to a recording, then it's a bit harder to get your questions in at that point. But yeah, we are going to record this and post stuff online. Yeah, cool. All right, well, my name again is Karen, and I'm going to be taking you through the session tonight. So here's an introduction. This is the first part of Forward Thinking Traders. It is a 4-part course, and every part's 2 hours long. So it's part of the education package that OANDA has put together, and it's categorized as the premium education because we assume that most of you have a live account already and are ready to trade. we offer an in-depth look at modern technical analysis. We're going to be showing you 2 trading strategies that we actually use in our trading. And you will learn the modern take on how to analyze price action and formulate your own trading decisions. So 2 trading strategies will be explored in this course, and they are putting together all of the different technical elements that you will learn alongside trend analysis and risk management. So let's have a look at each of the strategies in action. We will talk about the trend flow strategy, and as the name suggests, it is a strategy that allows you to trade with the trend. This is a short trade there. So I've got 2 charts up on screen. The left chart is what we call our precision or our trigger chart, and the one on the right is the confirmation chart. So we're never going to be looking at the market just in one time frame alone. We're going to be looking for confirmation. We're going to start building things into our checklists, which if we manage to tick off, they're just going to increase the probability of having a successful trade. Now, if you just want to help me out here by letting me know where you're at in your trading journey, so if you're a beginner, just type beginner, intermediate or experienced, let me know what your trading level is like, and we can really tailor the presentation tonight to suit the room, basically. Also, let me know where you're from. So if you're from, I think most of you will be from the States tonight. It pays to check before you start trading what are the products available in your geographical region. Because due to some of the regulations in different countries, not all of the products that OANDA offers is going to be on the platform in your country of residence. So yeah, just check and find out what is available for you to trade. Cool, great. All right, we've got some terrific responses there. I seem to get the feeling that most of you are intermediate. Yeah? Okay, that's great. That's very good. Personally, I have been trading for about a decade now. Started in 2006. So, yeah, it's really lovely to chat with people who are, well on their way in their trading journeys. Okay, so that was a short trade example. The trend flow strategy can also be used to buy into a market. So these are some charts that we have captured of a long trade on the Euro-Yen market. Okay, I just want you guys to take a quick, squiz at this and see how many reasons you can list for going into this potential long trade. Okay, so just take a quick pause and write down as many reasons as you can think of why you might want to enter this market on the buy side. Okay, so I won't get you to read your list out right now, but if you can just hold on to it, as we go along, you'll see some of the reasons that professional traders use, and you can compare your list to the reasons that a professional might use when they enter a trade with trend. The other trading strategy we're going to be looking at as part of forward thinking traders is the momentum breakout. So as the name suggests, this is not so much a trend following strategy, but rather it's waiting for the market to push through a level where it might be finding some resistance or support. So we've got the trigger chart on the left, and then we've got the confirmation chart on the right. There's a black line there on screen. For the beginners in the room, what that indicates is a level of support. And the idea behind the strategy is that when we see price consolidating around a level like that, we will be looking for opportunities to trade with the trend when the price pushes through that barrier. Okay, so have a go at listing the potential reasons for getting into the short trade. And like I said just now, we will be comparing the reasons you have with the reasons the professionals have as we go along in the session tonight. You can also use the momentum breakout strategy for a long trade. And here are some examples. The black line again marks a level of resistance. Okay, generally when it's an uptrend, we think of them as floors and ceilings. This is a ceiling. The price pushes through, then the theory is that the momentum will push it through, kind of like the eruption of lava of a volcano. Now everyone, I am from New Zealand. I live in New Zealand. So if any of my analogies don't quite make sense to you, let me know. We are a country which is relatively young and there's still a lot of seismic activity. So I talk about volcanoes, talk about sheep a lot. Just let me know if any of those analogies don't make sense to you. Okay? So I won't get you guys to write the reasons. But yeah, basically they do center around technical analysis and a stacking of several reasons to enter that trade rather than just one. So here are some truths about trading. For those of you who are interested in medium to long-term trading, are you swing trading? Yep. You may have heard that it allows more time for you to analyze the markets and therefore you can put more effort into carefully planning your trades. It is more relaxed than day trading. Day trading is when you enter and exit a trade within the space of a day, and generally that involves a lot of screen time, probably more effort in analyzing their short-term market movements than compared to the medium term. Bouncing back from a bad patch can sometimes set you up better than winning right from the get-go. That's counterintuitive because a lot of people who come to trading do want successful trades straight away. I mean, you are risking your hard-earned capital, so it's only natural that you want to win from the get-go. But as you will see, trading is something that is emotionally challenging. So if you get what you want straight away, you may not be going through the process where you are training yourself to accept losses as part of trading. Now, in order to be a sustainable trader, someone who's in the markets long term, you've got to get comfortable with losing trades. Okay? I can certainly tell you in the last 10 years, the losses occur for about half of my trades are losses. So you really have to learn how to control your risk and to accept that that's a normal part of trading. If you take only trades that are strictly conforming with the rules of your strategy, that's going to make your results more likely to be consistent and predictable. Simply because you've got a framework to refer to when things go wrong. And you can review what you've done in order to make changes and improve. Strategies are crucial. However, managing risk is also equally important. Your mindset is key in handling risk. It's a lot more important than people will lead you to believe. I think when you come to trading quite fresh, you don't realize the psychology that goes on behind the scenes. You don't realize that you may have an adverse emotional reaction when you encounter a losing trade. So for beginners who come in thinking that they want to make money straight away, or if their focus is too skewed in that direction, what happens is they will overlook the risk management side of things and basically shoot themselves in the foot. If you don't think about risk management, then you are actually setting yourself up for failure. So trading strategies are one thing, but learning to flawlessly execute them is another. Having a trading strategy will take the guesswork out of trading, but you need to be able to consistently apply that strategy because if you do not consistently do it, there introduces an element of chance, and it's going to be very hard to review what you've done poorly and what you've done well. So if you can keep these 7 things in mind, they're just really common truths about trading, and I hope that will sort of frame the information that we're going to talk about next, just to sort of adopt or make it easier for you to adopt the probabilistic mindset, that sort of thinking in terms of risk and reward and probabilities. Okay, that's where we're going to go today. So quite a few intermediate traders, you will be wanting to trade for the lifestyle. And to dispel any myths that we have, you do not need to be trading full-time to make a full-time income. All right, so there's certainly not a direct correlation between screen time and profitability, and certainly being able to control when you're in front of your screen and the markets you're looking at is one of the appealing aspects of trading. So in order to become a good trader, the focus should be on selecting trades that meet your strategy rules. Okay, it's not so much about trading the markets that someone successful is trading. It's not about trading exactly the same way as someone else. It's about finding what works for you and making that fit around the life that you have to achieve the life that you want to build. So personally for me, when I came in, I said, oh, okay, I've only got, at the time I was working full-time in a bank, and I wanted to trade for 2 hours in the evenings, okay? And then even then it was such a push to get 2 hours every night to myself. So it kind of varies, you know, with any changes in your life. And that's the beauty of trading. You are totally free to come in and analyze those markets, particularly Forex markets that trade around the clock, anytime you want. And with the advent of technology, being able to place a specific order to buy when that particular price comes up, that actually frees you from having to sit in front of your screen waiting for that opportunity. So it's quite easy. You go and you analyze the markets, you place your orders, and all you have to do then is walk away. Subject to, of course, considering risk management, because for some people, risk management means being there to close the trade if something goes wrong. Well, let me just tell you this. When the trade is actually in progress, it becomes very, very hard to stay impartial, and it's normally a lot better if you just put in a stop-loss order at the same time you enter a trade. So in order to think like a trader, the first step is to accept that mindset is going to be one of the important characteristics that will determine whether you are successful or not. You can't say that any clearer, and I get the feeling that most of you are already very experienced, so you may have come across this book called Market Wizards, written by Jack Schwager. Now, he interviewed some of the most successful traders at the time, and I highly recommend picking up these two books if you haven't already read them. Here are some of the similarities between the successful traders. There are some differences as well, but basically they make for very interesting lessons. I mean, I like reflecting on my own trading career and thinking, you know, could I have done it any differently? Is there anything that I still need to work on? And the principles sort of teased out in these books still hold true to me even today. So what is different about those market wizards? Well, every single one of those traders interviewed in the book came from different backgrounds. They were not the same age. Some of them were educated, some were not. They didn't have, they weren't trading the same thing, basically. They traded different markets. And in terms of time frames, some were short-term traders, some were medium-term swing traders, and some were even investors. So there wasn't really a common thread in terms of the demographic of that group. If you look at the strategies that were trading, in fact, some of them used technicals and others used fundamental indicators. Some were trading their own private accounts and some were trading for hedge funds and banks. Many of them were self-taught. Others maybe had a mentor that they were shadowing. Most of them were discretionary. Okay, so there is a lot of talk lately, all right, this is topical. Do we trade ourselves? So going there being the human behind the computer, or do we use AI and write algorithms? Okay, most of the traders in market wizards were discretionary, so they were sitting there making the calls themselves. But yes, some of them were also pioneers of algorithmic trading. Now, to be honest, what you do personally isn't really going to make a difference as long as it suits your lifestyle. Okay, there's no point trying to write code when you're not really tech savvy, for example. If you're going to spend more time learning the code, then don't, write the code. What works is what suits you best. And the reason for that is you won't be expending too much energy on things that are not consequential to trading. So pick something that fits your lifestyle, fits your character and your personality, and just work at being able to do that exceptionally well. All right? AI may be fascinating and interesting and everything, but I want you to remember that what you put in is what you're going to get out. So it's only as good as the inputs. I've got a friend who likes to say rubbish in, rubbish out. That's basically what happens if you don't know how to trade to start with. Okay? So some of these market wizards traded as group, some of them traded as individuals, but the key point is, what is the commonality between the whole group? So here are some of the characteristics that all of the market wizards shared. They were all confident in their strategy, okay? And this does come some part from experience. The more you do something and enjoy success from it, the more confident you are in being able to achieve your outcome. They were all disciplined. So at the beginning, even though they experienced drawdowns and losses, they stuck to their rules. They focused on managing their risk instead of making money. Again, that's what I meant about it being counterintuitive. When you come to trading, you are attracted by the profit, yes, I won't deny that. However, controlling your risk, focusing on preserving your capital is actually more important. All right? That combined with flawless execution help these market wizards profit instead of loss. And they thought in probabilities. Okay, so while they were practicing how to execute the rules, they were also thinking, what is the chance of incurring a loss on this trade? What am I putting up at risk? And what is the chance of a profitable trade? And what is the dollar value? So they do, work out their profit and loss in that sense. And they always know what is the likely drawdown on their account and make their trading decisions based on that. So because they weren't a uniform group, when interviewed, they didn't particularly elaborate on the indicators or techniques they were using. But most of them did talk about the psychological side of trading. So things like discipline, emotional control, patience, and keeping a positive mental attitude. It sent a very clear message. The key to winning in the markets actually comes from within. So it really depends on who you are as a person, whether or not you're disciplined, rather than, say, external factors like the strategy you're using and the market that you're trading. Okay? So what do I mean by thinking in probabilities? First of all, you need to be aware of the loss that you might incur on any given trade. That doesn't mean that you don't have to think about the profit, but you will be more concerned with the risk of loss because that is what keeps you in the game in the long run. So hypothetically, if I've got a fair coin, all right, one that gives you a half and half chance of flipping heads, and I tell you, if I flip heads, I'll give you $15. However, if I flip tails, you've got to give me $10. And we'll flip that coin once a day, every day, for a year. So for those of you who are new to this concept, risk reward is what you stand to gain versus what you stand to lose. And in this case, since you win $15 every time I flip heads, and you lose 10 when I don't, the risk to reward ratio is 1.5 to 1. Okay, and there's an even chance of success on this game. Will you play simply based on the probabilities alone? Cool, great. Quite a few of you saying yes, you will play the game. This is what we got by putting that through a random number generator. Okay, so we got to randomly generate a series of wins and losses based on those probabilities. So over 365 flips, what the program came up with was 195 heads and 170 tails. Okay, so that's roughly 50-50. Now if you look at the sort of highlighted areas on that little picture there, what do you think about the frequency of the winning and losing streaks? Is that what you expect? Well, the biggest run of losing flips there was 10 consecutive losses. All right. You're probably wondering why I'm spending time walking you through this example. That's because it is directly analogous to the game of trading. All right. So when you think about the results of the example, in trading, we only have two outcomes. You either have a successful trade or you have a losing trade. Okay? The probability of winning or losing is actually 50-50. So it's an even chance game. Nevertheless, why people do get very caught up in trading because the emotions come into play. And sometimes it does feel like the market's out to get you because you're not accepting the probability of those 10 consecutive losses. So do you see why I'm saying emotions become very, very important? And in order to totally remove your emotions or at least control them, you've got to understand that with any trading strategy, you're going to be exposed to win-loss ratios. You're going to be exposed to reward to risk. All right? So to play the trading game, you've got to accept that every trade is random. It's independent and random. And you've got to accept that you could equally lose or win money. You could equally flip a heads or tails. It's the same thing with trading. You can equally get a win or a losing trade. Yeah? So this is why we use that little analogy there. And this is what your equity curve looks like on the same parameters, on the same rules of that game. So from our random number generator, we won 53% of the time. And every time we won, we gained $15. So here we go, 195 times we won out of 365. We gained $2,925. However, we also flipped tails quite a number of times. And we lost across 170 losing flips, 1,700. So combining those two figures, offsetting them, the total reward or the total profit is 1,225. So I hope the numbers are starting to make things a little bit more clear. No matter how good or consistent your system is, or how good or consistent you are going to experience periods of drawdowns. So you see on those charts we've marked out the sort of areas where the equity curve has not grown. Yeah, that's generally where you've got consecutive losses, that 10 losing streak. Yep, it's up there sort of at the top. Not only will your equity curve not grow, because you're not always going to be guaranteed a winning trade, it may also decrease. And trust me, you will feel frustration. Understanding the numbers and the probabilities behind the game does help alleviate frustration somehow, but it's a constant process to remind yourself. Not to be caught up in the emotional roller coaster, not to expect that your results are going to be correlated to the hours that you put in. This is different from employment. This is different from the business. This is very much a game of calculated risk. So every trade that you take in isolation is random. Do you accept that the results of every flip are random and you could equally lose and make money? Do you accept that this is true for every trade you place? In the coin game, we actually had an edge. So the risk reward was in our favor. What happens if you stand to only gain $10 and lose $10? What if the risk reward is 1-to-1? Will you still take the trade? So in trading, we are attempting to formulate our behaviors in relation to those parameters in trading. We're going to try our best to increase the probability of success, either through achieving an edge in terms of the numbers of wins and losses, so the win-loss ratio, or in terms of risk-reward, because these are things that you can control. So trading is only a profession, as Jack rightly says, where the amateur has a 50-50 chance of getting it right. So we've only got two outcomes. It can either be win or lose. But the things that are within your control are risk-reward and also the number of winning and losing trades. Okay, so those are the two key metrics. And in order to estimate profitability of your strategy, I want you to track the following two items in your trading. So you need to look at the win-loss ratio, and that is the percentage of trades that you win. If your win-loss ratio is 60%, that implies that every 10 trades you win 6 and lose 4. The other thing that you control is risk-reward. So that is your expected return for every unit of risk you take on. 1-to-1 means you risk 1% to make 1%. 2-to-1 means you risk 1% to make 2%. Now, larger risk-reward generally does correlate to lower win-loss ratios, simply because the price has to travel further in the direction in order for you to have a successful trade. So because it needs to travel further, that generally reduces the number of trades that will reach that threshold. When you do not have as many trades, then the win-loss naturally drops. So it's up to you whether you want to vary the risk-reward or the win-loss. Does that all make sense? Yeah, if it doesn't make sense, just let me know, okay? Great, okay. I worry that this might be a bit too technical. Okay, don't worry, we'll be looking at some examples soon. But I just want to explain the reasoning behind it. Because I find that once you understand the reasoning behind it, then it's much easier to see how it comes into play when you are looking at charts on your screen and planning your trades. Okay? So we've got two strategies here. We've got one with a win-loss ratio of 60% and 1-to-1 risk-reward. Now we've got strategy B, which is a 40% win-loss ratio, but it's got a wider risk-reward of 2-to-1. So looking at the different metrics under those two strategies, let's consider the one on the left first. If we've got 60% win-loss, in 10 trades we'll have 6 wins and we'll have 4 losses. Since risk-reward is 1-to-1, every time we win we're going to gain 1%, and over 6 winning trades we'll be 6% up. The same logic applies to the 4 losing trades. So every time we lose, we're going to lose 1%. So over 4 losses, we will lose 4%. Overall, netting those two figures off against each other, we will gain 2% on your average trade. Now under strategy B, because that win-loss ratio is lower, we'll actually only have 4 successful trades out of 10. However, we gain more because that risk reward is higher. So 4 wins where we gain 2% gives us an overall profit of 8. Conversely, on the losing trades, because the risk reward is 2-to-1, we're losing 1 every time we incur a loss. So across 6 losing trades, that equates to a loss of 6%. So again, offsetting the profit and the loss, you get a net overall gain of 2%. Okay, so it's the same across 10 trades. Under both scenarios, you will gain an average of 0.2% on each trade, and your total profit after you take 10 trades, it's going to be the same as well, 2%. But let me ask you this now. Which strategy do you prefer and why? Is the money, is the gain the only consideration? Great. I think most of you have cottoned on to the idea already. So quite a few of you are saying you prefer strategy A. And the reasons that you're giving are that it wins more, it improves your confidence, it keeps you in a positive mindset. Yeah, it really depends on who you are as a person. I would prefer strategy A as well, simply for those reasons. I find it quite hard to get myself out of a slump. And if I was trading strategy B and losing 6 times every 10 trades, I would find that it would affect my morale and I wouldn't be able to stay impartial and analyze each trade in isolation. So yeah, it really comes down to your personality and how you like to trade. Okay, so I'm very glad that you know, most of you, if not all, have picked up on that point. Money is definitely not the only consideration. So mindset is equally important, and you will need to develop what we call the trader's mindset. So the proper attitude and behaviors will support your ability to make difficult trading decisions. And trading can get quite difficult at times, especially when perhaps you've had a consecutive run of losses, even though you are doing everything properly and accurately. So the ultimate question really is whether you are committed to putting in the time to learn, whether you're committed to practicing and to reviewing your trading. What else can you do to improve? Well, potentially, I suppose, the most effective and functioning trading belief, something that if you can grasp early on in your trading career, will help you tremendously, is the idea that anything can happen. So it's very common actually, because a lot of traders do come to the market with type A personalities. So myself, having worked in a bank for a while, having always believed that putting in hard work was the answer to overcoming challenges, I certainly came in expecting my results to be positively correlated with my effort. But the market is a living and breathing thing. It's made up of people. So you've got people on the demand side, you've got people on the supply side. And these two forces interact with each other. They're really powerful. There's a large number of trades and trading volume behind these movements. So trying as a single trader in the market to control that volume is impossible. So the earlier on that you can accept anything can happen, and the earlier that you prepare yourself for trading losses and accepting those losses, the better the position that you're going to be in when it comes to actually trading and charting your course. So here's the difference between a winning trading mindset and a losing one. So trader A comes to the market, he expects every trade to cut with a positive outcome. However, trader A also accepts full responsibility. So he doesn't blame the market, and he learns from his mistakes. Trader B, on the other hand, is looking to assign fault. So whenever a losing trade happens, trader B tries to find someone to blame. It's either the market that's out to get him, or he'll blame his broker, he'll blame the platform, he'll blame everything except himself for the trading loss. Even when, say, mistakes are pointed out to him, he can't learn. He refuses to believe that he could have done something differently to change the outcome. So if you had a choice to put your hard-earned capital with trader A or trader B, who is it that you're going to choose to place your money with? It's not a hypothetical question. It's not a trick question either. These two traders are very, very different. And it's going to show in the equity curve as well, in their individual equity curves. I would place my money with trader A, because trader A is also like the trader who chose strategy 1. They are more positive, they are more able to bounce back from trading mistakes, and every trade they see as a new opportunity to be successful. Now, visualization is a technique that a lot of sports people use. Apparently that's what Richard Branson uses as well. You know, he believes that if he can see it, he can do it. So how is visualization going to help you in your trading? Well, it is quite, it sounds very basic, but it is really useful if you think about the perfect setup in your mind. You imagine achieving a successful trading outcome, and you accept that you have no control over that. However, you place your focus on flawlessly executing your trades in accordance with your strategy. Then overall, knowing that will help you channel your energies towards being positive and achieving a positive outcome. We all know that losses do happen in trading, so being able to accept and get over those losing trades without spending too much energy complaining and sulking will help you channel your focus towards the things that you could be doing better. Ultimately, trading is about having fun. If you don't enjoy it, you're not going to be able to do it in the long run. So make trading fun for you. Accept that it is possible to incur a loss, but do not blame yourself if that happens. Simply look for areas of your trading strategy where you can improve and focus on the positives. Because in the long run, that's going to get you through those horrible periods where you've got 10 consecutive losses, where things don't seem to go your way. Accepting your mistakes and reviewing the areas and asking for help where you need is what's going to get you to trading success. And that only makes sense, you know, over a large number of trades. You're not going to be successful from day one, I'm afraid. So it's only through a long-term trading experience in a large number of trades that you're going to be observing this phenomenon and just sort of kind of realizing that that is true in trading. It took me a while, certainly, because in the beginning when someone told me I wasn't able to control whether or not I'd be successful, I actually laughed at them. But it is really true. Statistics and probabilities are only observable when you look at it through a sort of big picture perspective. Okay, so mindset, here are some important things to keep in mind. Trading can be frustrating, not because it's difficult, but because there's lots to learn. You will make many mistakes. Sometimes you'll feel like you're making the same mistakes again, but each opportunity is for learning. You never really lose. You only lose if you don't learn something. And if you believe that you can achieve better trading results when you put your mind to it, that will help you greatly in sticking to your trading strategy. Michael Jordan, I really like him. He used to play for Chicago Bulls. I used to watch his games. He failed over and over again. That's why he succeeded. And Henry Ford said that if you think you can, you can. And if you think you can't, you can't. Either way, you're going to be right. So I don't know about you, but if you visualize a positive outcome and you work towards it, then I think Mr. Ford is going to be correct about you in the sense that you will get there because you think you can. Alright, so that was all the waffly emotional stuff. I've had some of you type in to say that that wasn't really useful, that's stuff you know. Okay, that's great. Just had to remind you about that. Let's get into the technical side of things. This is more my area of interest. So trading needs to be logical, right? if every bit of technical analysis is going to increase your probability of winning, what does logic dictate when you have more than one of those technical factors? All right, so trade with precision, we're operating on the premise that if you manage to get more and more indicators confirming the direction of the trade, then that's going to correspond to a higher probability of a successful trading strategy. All right, we trade based on logic and probability. Trading is not about guesswork or sort of going with your gut feel. In the beginning, you might be looking at the markets and watching the price action, watching those charts either trend higher or trend lower. But the moment you join a trend, you can't really leave that up to chance. If you do leave it up to chance, your results are also going to be the product of chance. In order to take control of your trading, to own that trading strategy and to know what you can do differently to improve, you are going to have to use logic and think in terms of probabilities. Now, having more than one technical indicator does not mean that trading is difficult. It just means that you need to learn how to do or look at all of these different things at the same time. It's a very often or too often used cliche, but when you drive a car, especially a manual car, when you first start, you need to remember where you put your foot, put your foot on the clutch, when to put your foot on gas, when to move the gears into first, second, third gear. It all seemed a bit overwhelming at that point. But guess what? Once you master it, it just becomes simple. It becomes a natural process. And the same is true of trading. Like even those of you who are intermediate traders, you all have a clutch of indicators that you look at. In the beginning, it might have been difficult to determine what the indicators were telling you. But now when you look at them, you know straight away, okay, if I see this converging, that's what it's telling me about volume. If I see sort of a resistance line forming, is this when I can use a breakout strategy? Once you master all of these different indicators and feed them into your trading decision, then it becomes simple and you can focus on just looking for the best trades. So let's have a look at these two charts. The one on the left is covered in all kinds of technical stuff. The one on the right is a simple chart. They're both the same market. So at True Precision, we like to keep it simple, okay? Because sometimes when you make it too complicated, you end up becoming stupid, for lack of a better word. If you can focus just on the price action, on the purest form of data, and use 3 to 4 simple indicators, not in a complicated way, but in a straightforward, easy to understand way. It's got to be so simple that even, say, your teenager could do it. All right? That's when you put it all together, you stack each bit of information in your favor, combine it with risk management, and then you will master trading. If you think about your strengths in life, what have you already mastered? And how do these skill sets translate to helping you master trading? It is kind of like those two strategies that we talked about just now, strategy A and strategy B. Knowing who you are and how you react to challenges or successes will determine the areas that you work on in your own trading. Okay, so quite a few of you said you wanted to stay confident in your trading strategy, you wanted to have more wins than losses. Those of you falling in that camp know that it's the path that makes the most logical sense when you're working on trading, because that is the way your personality and the way you react to challenging situations. That dictates sort of the steps that you would take to improve, if you may. Doesn't matter which strategy you prefer. Maybe you are a battler, a fighter, someone who only improves when there's a fire under your bum. But regardless of which camp you fall into, those who are going to be successful at trading will use the skills that they've learned to master price action. When you master price action and you understand the technical indicators around it, the probabilities do in some way look after themselves. Okay, so understanding the different elements, adding them together, the probabilities naturally stack up together. So let's talk about price action. Price action are those colorful bars that you see on your trading screen. They're simply graphical representations of past or historic price data, and we plot them on a chart without adding any fancy overlays or indicators. We bother with price because it is the purest form of data, and everything we put on top is a calculation or some kind of transformation of that measure. You need to first understand the price action before you can build on it. It's the foundation that will help you when you are looking at the other technical indicators, because you need to kind of have the detailed understanding of the foundations first. And what level of understanding is required, you might ask? Well, you need to know them so well that they are second nature almost. So 6 points there. When you start out, you'll be looking for optimal chart structure. We'll talk about what that means. We'll look at trading with a trend. I'll recap trends for you in a sec. We'll look for price support and resistance. And we're going to look for moving average zones and patterns. Candlesticks are important. And as you saw with the examples that I had for trend flow and momentum breakout, we will be combining different time frames together when we are tying up the probabilities. You never really look at one thing in isolation. So let's start with optimal price structure and focus more time on combining everything. Okay, we don't just want to talk about each technical indicator and not combine them together, because it's combining them together that actually gives you the edge in your strategy. Are we going okay? Like, I'm concerned that maybe the beginners haven't said anything, and we are probably getting a bit too deep into it too quickly. Yeah, are we all right? Okay, good, very good. Please do stop me if anything is not clear, or let me know as well if this is all easy stuff for you and you want to get to the platform demonstration sooner. Okay, we're just up at the 1 hour mark. We've got about another hour to go. All right, so price action, okay, price structure. Now, when we talk about optimal price structure, we are looking for charts which show us smooth, flowing, trending markets. You can only add on technical indicators and overlays where the chart possesses optimal chart structure. Because if the foundations are not solid, if price action is not doing what is expected of a smooth, predictable market, then adding on the factors on top of that isn't really going to be helpful, because it's sort of trying to cover up on the deficiencies that are already in existence. You can't fix the market by adding an indicator onto it. So charts that are not trending, charts which have lots of gaps, charts which have candles with big tails, wicks or shadows, and charts which are all over the place. These are all examples of price action to avoid. The reason we avoid them is because when they're not giving us that optimal chart structure, that tells us that there are more amateurs in their market and they behave in a less predictable fashion. Amateurs trade on emotion and gut reactions, so their orders and the volume in that market is not so predictable. You really want to position yourselves with a predictable momentum. And when you can't predict the momentum, there's really no point to take that trade. Trends are by far the most important thing to look for because they tell you which party is in control in that market. You can think about it as a battle, really. So the price that you're seeing on the screen, it really tells you the story of whether the bulls are winning the battle or the bears are winning the battle. Okay, the bulls are the ones who want to push the market higher. The bears are the ones who want to push the market lower. So in order to position yourselves with the stronger party, you've got to identify who that is and just trade with that trend. The trend tells us very quickly who has been in control in the period past. Whether you're looking at a 15-minute chart, a 1-hour chart, 4 hours, 8 hours, every trend on that time frame will tell you a story of who has won the battle between the bulls and the bears. Trends, therefore, are actually really simple to understand. Okay, quite quickly you can tell who's in charge. But they are also the least understood and actually often overlooked form of technical analysis. It's like it's almost too simple to pay attention to, and as soon as someone sees a market, they go, all right, that looks like a trend. They'll jump right in with both feet. Now, we don't want to do that. We only want to trade with the best trends because trend trading is high probability. All right? If we have a nice, stable, predictable trend, then going with that trend means that you've got the benefit of market momentum behind you. You've got the benefit of that large group of people who are winning the battle, either the bulls or the bears, lending support to that trade that you're going to take. We don't want to pick places where the trend is changing. All right, so there's been a lot of focus as well on turnaround points. Okay, so that means people looking to pick parts of the trend where they think the control is going to move from one side of the market to the other. But do you really want to do that? Like, why would you take a bet on who's going to win? Instead, if you already know who the clear winner is, it just makes sense to go along with them instead of trying to guess who's going to win next. So here are some common mistakes that happen to all of us now and then. When the emphasis is not on trend trading, it is very common for new traders to go very wrong because they start telling themselves the market can't go any higher, or it's really cheap down here, let's buy it. Most of you are from America, so you will remember Enron, the company. So before Enron went bankrupt, as late as October, the 15 analysts who were working on Enron, who were putting out these strategic calls, either buy or sell ratings, they were still thinking that Enron was cheap as the share price was falling. 11 out of the 15 rated it a strong buy. A couple of them said hold on the stock, and only one analyst out of the 15 said sell. This is a strong sell. So when you think about it, there's a bit of self-confirmation bias going on there. If you want to buy the stock, you will find any reason to buy into that stock. In spite of Enron's fraud becoming public, yeah, some of those analysts were still recommending that people and investors put their hard-earned money into those shares. And it's very clear they got that spectacularly wrong. So yes, Linda Bradford Rush, she's one of the market wizards, and she says the number one lesson to learn in her 30 years of trading is that the market can always go higher or lower than you think it can. So be prepared. Don't try and pick tops and bottoms. Don't think, yes, it can't go any lower, therefore I'll buy here. Seems like a rational price. Or it's so high now, it probably isn't going to climb anymore. Let's sell. Those two approaches are tantamount to picking tops and bottoms. And what you really want to do is just ride the trend. If the market is bullish, if it keeps going higher, then look for a logical, low-risk place to join that trend. But don't try to fight the trend unless there are indications that it is running out of steam. So at OANDA, we teach trends as the first thing when we talk about trading strategies. Like I said, many new traders will memorize the definition of trends. So they'll go, okay, uptrend, higher high, higher low, downtrend, lower high, lower low, and then they'll forget everything. This is a big mistake. When you are trading technicals, the trend is the most important thing. And even if you do trade counter trend, you've got to recognize, you've got to already understand trends so well to the point where you can recognize when a trend is weakening or when you can recognize the beginnings of a new strong trend. So do not paddle against the current. If you trade against the trend, you are going to wear yourself down basically because you are trying to paddle upstream when everyone else is going downstream. So here's a refresher. Here's how you identify trends on a chart. So the key to doing so is to use only price action, to use only the purest form of the data to pick whether that market is trending. So an uptrend means the price action is making higher highs and higher lows, whereas in the downtrend it's making lower highs and lower lows. When we overlay those trend lines with the price action itself, this is what it looks like. Okay? So it may not always be equal highs because the market is living. It doesn't just move in predictable, consistent waves. There will be periods when the buying momentum is stronger and you'll see a sharper push, a sharper increase. And there will be times when that sort of drop is really quick or people are reacting to news and you will see the movement sort of pan out very gradually. So rather than trying to pick the exact way that that trend is going to unfold, it's a lot easier to just understand the theories of lows and highs and just focus on looking for the patterns in the price action. We want to avoid markets that are not trending, okay? Because when you don't have a clear series of highs and lows, that makes the next move in the market very, very hard to pick. Okay? So I'm just going to take a quick pause now for questions. If you have anything you want to clarify about trends, do just pop them up there. But otherwise, this is also a good point for, I suppose, everyone to have a quick water break. And we'll get back to it in probably 3 to 5 minutes. Okay? Feel free to ask me questions while we take a break. Okay? Just type whatever you want in the question and answers box. The way you ask me questions, if you could, would be to just type them in the chat box. I know there's an option for you to raise your hand, but I can't actually see your question if you don't type it and send it in. Okay, cool. All right, so a couple of you want to know whether the recording will be available and when it will be available. I am recording the session, but I'm not too sure how long admin takes to put it up. But I suppose when it is available, you'll get a link in your emails, and you'll be able to access the recording afterwards. Right. Okay, David wants to know if I'm going to cover scalping. Not in this session particularly, David. This is just an introduction to technical trading. But we will be talking about, I suppose, the mindset of scalpers. And we'll be able to look at some of the markets later, particularly the shorter term ones. You'll find that when you are looking at a shorter term market, the trends are a bit harder to identify because that time frame is just so minute. Whereas a trend is easier to spot on, say, a medium to longer term market, like maybe an hour to probably about an 8 hour sort of kind of time frame. Does that make sense? Scalpers do operate pretty much on the theory that you are trading in large quantities, and you're doing those trades very quickly and with the aim to capture the spread of the market or very, very small movements. So yeah, it requires a lot of energy as well, and the ability to stay impartial and stick to the strategy accurately. Yep. Sante, is that how I say your name? Yep. Sante wants to know if this is considered a channel or a trend. Zonte, as I understand it, channels are a specific pattern that you see on a chart. Okay, so a channel would be, say, a trend that is confined between two very narrow price bands. I'm going to focus exclusively on trends because you need to understand those first before you apply any other indicators. So just try and keep it simple for now. Just make sure you can tell the difference between an uptrend, a downtrend, and when that market is not trending. Okay? Chad wants to know if we use VWAP. So if it's W, I'm not sure what that is actually. My apologies. So it was weighted volume average price, but no. We keep things simple. We're just looking at some of the very common technical analysis indicators because we find that complexity is not what makes successful trades. I mean, you could have a very complex indicator giving you the same signal as a simpler one. So what we're doing is we're using simple tools, and then we're looking for alignment. We're looking for quite a few of them to give us the same result, because the more indicators that confirm what we're looking at, the higher that probability is going to be of having a successful trade. That is that's the basic theory behind it. Okay, Mitchell asked a very good question. Mitchell wants to know how many points in a price action chart are needed before you know that a trend has formed. That's a very good question. So we're going to use that to segue into the next part of the course now. I hope you all had a bit of a water break and you're ready to go. Okay, let us continue and look at when we know that trends are forming. So here we go, changing of the trends. Now, great opportunities can exist at the start of a trend simply because that is where the potential move for the move is the greatest. Novice traders will look to pick tops and bottoms simply because they want to harness the movement of that trend. Okay? We do not want to pick the exact turning point. As I suggested to you just now, if you pick turning points, that is like trying to catch 49s and trying to guess where that market's going, sticking a finger up in the air and trying to figure out where the wind is going to blow next. You wouldn't do that. What you want to do is look for confirmation. You want a new trend, yes, but you want to begin only after that trend is confirmed. So Mitchell's question is really, really good because he's asking how many points are needed before we can get in, before we know for sure that it's an uptrend or a downtrend. Okay, it's a very, very good question. So here we go. This is how you tell when a trend is changing. There are going to be two scenarios, okay? So here's the first one. We get a bit of a clue, all right? There's an indication that a new uptrend may be beginning when the price makes a higher low. Let me get my pointer out. So what I'm talking about is this bit here. So if price action has been downtrending so far, when you get to a point where it reverses, there is a little bit of a clue that the market might be turning around when you see this higher low. Okay, so downtrend, lower low, lower high, lower low, lower high, that's a downtrend. However, this is the clue. When that price comes and makes a higher low, it's time to set up a new seat. It's time to go, okay, maybe that could be the start of a new uptrend. But we're not picking bottoms, remember. We're not picking the low points in the market. We want to only get in after the trend's confirmed. So the confirmation happens when price bounces up from that higher low to break, you see that line there? To break the high that it had made previously. Okay, so at this point here, when that price pushes through the lower high, that is the point that the new uptrend is confirmed. Okay, so this is the clue, this is the confirmation here, and when it pushes on to a higher high, you know for sure already that it is in an uptrend. The market is in an uptrend. Okay. Conversely, if you already have an uptrend, so see higher, higher, low, higher, high, higher, low, higher, high, how do you know that the market may be running out of steam? You get a clue that it may be running out of steam when the market forms a lower high. Okay, so lower high, oh, okay, that's kind of a little clue again that this uptrend is going to turn into a downtrend. And we only trade upon confirmation, meaning we only know it's in a downtrend when the market breaks that previous low. Does everyone follow? Good, good, very, very good. This is important. If you don't follow, just let me know. Okay, so scenario one, two things to remember. First thing, we get a clue when we see a higher low or a lower high, and we get a confirmation when we push past the previous highs for an uptrend or when we push past the previous lows for a downtrend. Okay? Very easy. Now, scenario two. Scenario two is a little bit different. Okay? And I would consider this approach probably more aggressive than the other market. It's generally what you see on shorter time frames. Okay, so if you're scalping, perhaps this is what you will be looking out for. It's more aggressive because the markets are moving more jaggedly. That's the way to describe it. You get an indication or a clue that a downtrend may be turning into an uptrend when your price makes a higher high straight away. Okay? So lower low, lower high, lower low. It doesn't track to make a higher high first. It just goes straight, shoots up, and then that's when you would take that as a clue because it's higher than the previous high that the market made. However, you do not trade simply because it's made a higher high. What you are looking for is confirmation. So it also has to pull back to a higher low in order for you to be more certain that the uptrend is starting to form. Okay? So you wouldn't trade just because it's reached a higher high, but you'd be looking for this higher low to confirm it. And you'd be trading the break of that previous high. That is when you get a confirmed uptrend. On the other hand, when you're looking at uptrends changing into downtrends, the clue that you are looking for is actually that lower low. Okay? So you've got a high, you've got a low, a higher low here, and then you've got the market pulling back to make a lower low. This is your clue. It is not confirmation. Confirmation only happens when price pulls back up to a lower high and then tracks back down again. All right? So this is a more aggressive scenario. Think about that. Huh? If you have got any questions, we will discuss them in a sec. But that's what we're looking for. We're looking for changing points in the trend. And changing points are the clues. We only trade after that trend has been confirmed. The common mistakes when traders look at trends are when you expect that that trend needs to, I suppose, be in operation for a long period of time. Let me just dispel that myth. You can trade a trend as soon as it's confirmed. The first and the second pullback in the direction of the trend are really, are just as good places to join the trend as any of the subsequent pullbacks. So if you are able to join a trend on the first pullback or the second pullback, that's great. If you come to a trend a little bit later and you have to trade the third or the fourth or the fifth pullback, if the other indicators are also still in alignment, then those trades are still okay. But do not put off placing a trade just because you are worried about joining the market on the first or the second pullback. They're just as good places to join the trend as any of the subsequent ones. Okay, so that wraps up the session on trends. But please do not think that's the only content that you need to know. When we look at every trend on every chart, we're going to be looking at those things at a minimum, but there are also other factors that you might want to consider. Okay, so size of the candlestick, for example, previous support and resistance, for example. We overlay that on trends, and we really want to be joining the market movement rather than fighting it. Okay, so that's just the important stuff to remember. Now, quite a few of you are actually asking, okay, on what chart would I determine the new trend? On what time frame would I be focusing on? What we have just talked about can be applied to any chart in any time frame. Okay. Generally, trend trading happens over a longer term, so it'll be more a medium time frame to a longer time frame. It may be harder to see a trend forming on, say, a 5-second, like a tick chart, or even a 15-minute chart, but it's not impossible. Trend trading is important if you are planning to use the trend flow strategy, because the premise or the idea behind that strategy is to go with the stronger party winning the battle between buyers and sellers. That's when you will look at the trend. But yeah, it will work on any time frame. Okay. All right, if there are no further questions about trend, let us push on to practical examples. So I've got a chart here and I've marked out all the turning points. You may want to take a screenshot of this and just analyze it in your own time. But yeah, what we've got there are points where we had a bit of a clue that the market was turning around, and the subsequent confirmation of the clue by that market pushing further in the direction that it was going. So here, I've got an uptrend. I'll just walk you guys through it because it is important. So remember when we said an uptrend turns into a downtrend, we're looking for a clue when that market forms a lower low in scenario 1. So it's kind of gone a lower low, and then pulled back to a lower high. The lower, it formed a lower high and then pulled back to a lower low. Whoops, I got that wrong way around. But this is what I mean. You had the clue here, and then you were on the lookout for the confirmation. And the confirmation is when the market traded lower than its previous low. Okay? So the clue happened when it made a lower high, and then it pulled through the lower low, and that's when we know we are officially in a downtrend. So ticking along here, suddenly we get what? We get another clue. So we get a higher high. See that high there? And then see that high. This high is higher than this one. That's when we got a clue. However, we're not going to jump right in with both feet and start buying. We need to wait for confirmation, right? And we know that when a higher low forms. This is the previous low. This is the higher low. Now we are back in uptrend territory. The markets, obviously, no one knows how long they'll stay trending for. And again, we got a clue here in the shape of a lower high. Wait for confirmation, lower low, and then it's just rode that momentum out. And then again, vice versa, we had a clue, it broke past the highs, and then we had a bit of an uptrend. And now we don't know where it's trending next. Okay? So given this market, would you be looking at taking a buy trade or a short trade if you were going to enter it? It's not a trick question. You can just pop your answers in. Don't worry if you get it wrong. I just want to know if you would be trading, first of all, and if you were trading, which direction would you go in? Okay, cool. Thank you for your answers. It's not a trick question, so those of you who answered, you can feel happy for taking a position. And okay, so what we're looking at here is fundamental ideas, right? We covered trends. What trend is the market in now? It is in an uptrend because it's made a higher high. First of all, we know that we're going to trade in the direction of the trend. So that precludes a short trade because the market is in an uptrend. It precludes no trades because we do have a trend and we will be trading subject to risk reward and position sizing. So for those of you who said go long, that was the simple answer, but I qualify that by saying you would need to check whether you've got a sensible position to place your stop loss and whether it's a sensible trade to take based on your risk parameters. Okay? So that wraps up the section on trends. I'm sorry if a few of you are saying we're going a bit too fast. I'm trying to really summarize all of the materials of trends. But I do hope that you remember those simple rules. Okay? So the simple rules are optimal price structure, trade with the trend, do not trade where there's no trend. 3 things to remember. Alright, so what do we mean by optimal price structure? Again, it's where the charts don't have any gaps. Alright, gaps are very common when you've got markets that close for the day. Generally, they happen on equities. Markets that gap tend to show they've got low liquidity at certain points in time. And unless you are a specialist equities trader, I generally avoid the gappy charts. Try and stick with something that's nice, smooth, and flowing because you know that the price will hit every price point. It's not going to suddenly move up and expose you to more risk on the buy or the sell side. Avoid charts that have long candles, giant candles with big tails and wicks, because when the market is ranging so greatly, there is an increased risk of being whipsawed out of a trade. Okay, this does happen in stock charts. Some currencies do that too, but again, it is a poor indication. It's an indication of poor liquidity. Okay, we want to trade liquid markets. We want to trade stable markets because it gives us more certainty that the orders that we place will be executed at the price that we choose. Okay, so this is an example of an erratic price chart. Okay, and it's also very hard to figure out where that trend is headed, simply because it's very indecisive. When you've got a market that trades very high and suddenly very low, the buyers and the sellers haven't quite come to a point of equilibrium, and you really want to join the trend where it's in balance, because that's the best place where the energy is all contained. So if you're looking for an uptrend to join the market by buying long, this is what a textbook example would look like. So you've got a clear series of higher highs and higher lows. The candles are all sort of in a uniform size. They're not too big in relation to each other. They don't have long tails. Behavior in that market is steady, and that translates into steady buying momentum. If you're looking to go short and sell in a downtrend, you also want to look for optimal bearish structure where there are no gaps, where the lower highs and lower lows are consistent, and that just reflects steady selling momentum. Okay, these are the types of markets that you want to be looking out for. Nothing too extreme. All right, so let's get to the fun part. Let's go and look at the platform right now. So here we are. I've opened up FX Trade. For those of you trading on MT4, just be just be aware that some things are in different places on MT4, and also there you've got to trade in terms of lot sizes. But for those of you who are on FX Trade, this interface will be very familiar to you, no doubt. When you first get in there, it pays to set up your charts in a way that is visually pleasing to you. You can go into the tools there, and you can change things like font size, color scheme, and that just gives you some presets for the different colors that your chart can take. I generally like the white background because it's a lot easier to see where your indicators are at and also to look at the price action. You can change the color of the different overlays that you put in there, and that's completely up to you what color you pick. I just like to stick with standard green for up and red for down, and I've got my moving averages kind of in a color-coded way for me to quickly tell which one is on top of each other, etc., etc. Alright, so have a play around with your FX Trade, but when you get in, this is an interface that you will commonly see. I also like to put my charts up as really like full screen charts, because it just helps me to get a bigger picture and to see more data at one go. Everyone clear? Everyone on the same page? Okay, have a play around with FX Trade in your own time. What I normally do when I come in is to create a watch list. So every Monday morning, after downloading the economic calendar to see whether there are big news announcements coming up, I will go in and I will set up my charts. So all of the products that are available will be categorized, and these are the common ones that you can work through to see which are trending. So at the start of the week, I will be adding all, and I'll be going through them one by one to kind of identify which ones are trending. The ones that are not trending, I remove, and you can remove, for example, which was one I was not looking at. Maybe that one. That's an equities index. You can remove the ones that you're not looking at by clicking on them and just clicking remove. Alright? When you are happy with your changes, click save. You can click apply first. If you are not happy with your changes, just click cancel, and that will preserve the watch list at the last setting that you had it on. I will run through the charts, the different time frames. So earlier there was a question about scalping. there is an option to change the time frame of the charts that you've got available. So the smallest time frame is a tick chart, 5-second one, and then you've got 10 seconds, 15 seconds, 30 seconds. I would just put up a couple of these short-term ones because I wanted to make a point about trends being less observable on a shorter time frame. Okay, and then lastly, you can also choose whether your prices are reflected as a candlestick or a Heikin-Ashi, or even just an open, high-low, close bar. You know, it's very customizable. Just pick the one that you're most happy using. Okay? All right, so getting back to the trends now. So when we jump in there, we're going to be looking for, first of all, charts of optimum price structure. And just let me get rid of some of these indicators so you can see everything clearly. Okay, so is that better? Okay, let's get rid of that as well. Yeah, okay. Alright, so now we've got some price action up there on screen. We want to look for trends. So on a low time frame, you can see that the movements are generally more erratic because there isn't a lot of time for a trend to emerge. Moving up the different time frames, so that was a 5-second chart, let's go to a 15-minute chart. Generally you see that the candlesticks are bigger, the price range that they're traversing is comparatively bigger, still not very large on this chart, but there is an opportunity for it to start trending. You see that? It's a lot more consistent than if you had looked at it, say, on a smaller time frame. Okay? So let's just have a quick look. First of all, is there a trend here? Not really a downtrend, even though very quickly you can see that it's making lower highs. And I say that because a downtrend needs to have consecutively lower lows as well. The lows here are all over the place. So you've got a low, then a higher low, yes, a lower low, but then this is again a higher low. So it's not really a downtrend. It's not a perfect one. We wouldn't be putting too much attention into this. And generally at this point, I would switch over to the next product and do the same analysis looking for trends. Part of the trading strategies that you're going to learn in part 4 cover trend analysis, because the presumption, the three things that we were talking about just now, presume that trading strategies are based on there being a strong trend. If there's no trend, then putting a strategy on top of that isn't going to be the best idea because you do not already have a strong foundation. Does that make sense? Okay, well I hope it does. Going through the next chart, okay, we're just going to start scanning from the very low time frames. See what I mean? With the 5-second tick chart, it's closely bounded and it's just sort of all over the place. I don't know about you, but I can't see any clear pattern of higher highs and higher lows, or a clear pattern of lower highs and lower lows. This just looks like a ranging market to me. I don't scalp, so I wouldn't be able to shed any light on the techniques or the strategies that scalpers use. But certainly I can tell you from a mindset point of view that when I look at this, it probably will cause analysis paralysis for me personally, because I can't see trend. I need to have a clear trend in order for me to trade. Okay, so let's go back to the higher time frames and just see what we can spot. Is this useful? Do you like me taking you through how we spot trades, or would you prefer if I went straight to examples that I have been looking at, the ones where I really see a trend? Okay, well I might take you straight to some examples that I've found earlier, just because you are able to, I suppose, pick those tops and bottom, sorry, not the tops and bottom, pick the higher highs and higher lows in a more clearer way. Because right now you're not, I guess you're not quite sure what you're looking for. And me just clicking through these candlestick charts isn't really helpful because, you don't really see the patterns. There's a low there, there's a higher low, arguably a higher high, but then what's this? What's that? So rather than confuse you, let us go straight to the example that I found. Oh, okay. So I've been looking at the pound and Aussie dollar lately because after Brexit, we all know the pound's taken a bit of a beating. And the Aussie dollar is one of the more stable currencies in the block that I'm living in. This is also the thing, guys. Currencies are reflections of strength of different pairs. So when you have, say, a pair of currencies and one is more stable than the other, what you are more likely to observe will be a trend either in the up direction or the down direction. Okay, if both your currencies are very volatile, say pound against the yen, for example, then it's harder to find a trend because you know that the two currencies are moving relative to each other and you're not quite sure which of those moving parts is going to be the winner of that battle. Does that make sense? Okay, so oftentimes if I look at currency pairs, I'll be looking where one is stable and the other is moving, and vice versa to try and find a trend. That kind of reduces down the number of markets that I've got to look at. All right? So I've got the pound USD here, and I was looking at the 15-minute chart to start with. This doesn't look great at all because that candle is really, really large. But as I click through, now we start to see a little bit of a pattern coming out there. Okay. Okay. It's moved from when I saw it last. But this is what I was looking at previously. All right. I had a sort of consolidation part here, and then it had printed a high and then a higher low. So the uptrend would have been confirmed if it broke past this previous high. It's failed to do that actually. You can still see it hanging around here, but we do not have a confirmed uptrend at this stage because it hasn't managed to get past that swing high. All right? Does that make sense? Okay. If you guys want to call out markets that you've been looking at as well, we can go through them. But just having a look at the pound USD, for example. Yep, no, this is not an uptrend, not a good example of one. But we may be getting a signal of a turnaround. Okay, remember when an uptrend turns around to a downtrend, the clue that we get is a lower high, and then we've got that, but we don't have the confirmation because it's not making a lower low yet. So it's something to keep on your watch list, but right now I will probably just flag it and go and look for other things to trade. Alright, so I've been asked to take a look at the... Okay, so a couple of markets have been called out. We're going to look at the CAD and the Yen, and we're going to look at the Euro USD. Okay, CAD Yen, Euro USD. Cool. Now actually, before I get into the analysis, how about you call out to me what you're seeing? So this is the 15-minute chart. Take a minute to just look at it and tell me what you're seeing. But obviously it's a downtrend, right? So first of all, do we have optimal price structure? Are there gaps in the chart? Are the candles big? And quite quickly we can see that it's not gapping. The candles are not too big, though probably these pulls to the downside are a lot larger than the candles around it. But very clearly we've got a downtrend on the 15-minute chart. If you are going to enter a short trade based on this as the trigger chart, potentially what will concern me will be that market has already made quite a large movement in the direction of the trend. Remember we said the good place to join the trend is on a pullback. We've already had one pullback here, another pullback here, another pullback here. So if we were to join, it would be like joining on the fourth pullback. Now that by itself is not conclusive. It's one of the many things that you'll be looking at when you come around to the trend flow strategy. But it is a matter to just flag, because you do want to join trends which still have a decent amount of steam left in them. Okay. Also, another thing which you probably haven't learned, but I'll just quickly mention, is at this point your price is sort of hovering around 82. Okay, 82.2, 82.1. And if you go back, we zoom out, this seems to be a sort of historic point in that chart as well. There's a bit of a support level there. Okay, when we have support, we'd be concerned that the market is not going to be able to push through it and go lower. All right, you will start to get a feel for the tensions in that market. All right. Yes, it is true that it can always go lower. However, you need to balance that against the other indicators that you're seeing and the probability of success. The fact that it's reaching sort of a low in the last, probably, how many time frames is this? It's a couple of days actually. Last couple of days. Does that mean anything more? Okay, can we perhaps go on a higher time frame and do another chart? So you get an idea of the tensions that you need to weigh up. We're only at the first part of forward thinking traders today, so I would like to bring you back to the focus of trend analysis. But as you go along to the next part where you talk about moving averages, convergence and divergence, and putting it all together will give you a more complete view than simply just looking at trends alone. But yeah, I would probably be a little bit concerned about that, the fact that it's just coming up to the low of the chart, and also because those drops have been very sharp. Remember, I will only trade with the trend, so I'm considering a short trade here. That's why I'm saying I'd be a little bit concerned to do a short trade, and I definitely don't think we're at the point where we can do a long trade yet, because we need to have a hint that this may be turning around, and we need to have confirmation before we would even look at entering a buy trade. Okay, the 4-hour chart itself, yep, there's been a consistent downtrend, but this part here is erratic, so that would worry me. And yeah, even if I do think about joining this downtrend, yep, we certainly had a suggestion, a signal here with the lower low, confirmation of the lower high. I would have to have entered the trade up here to have been comfortable with with the risk reward and just the trend analysis. Right now it's probably moved a little bit to where I'm expecting it to pull back because that drops in quite sharp. Does that make sense? Yep, definitely downtrend. Yep. Okay, so for those of you who had a go analyzing the CAD yen, yep, you were right. It is a downtrend, and we will be looking trades to the short side. There's a question about moving averages. I'll just get to that in a second. But I really want you to look now at the trend of this chart. Okay, so there has been very steady selling interspersed with areas where that market's tried to push higher but failed. And it's just continued down. In terms of the trend, yes, it is still down overall. But when we look at that little part in isolation, the part which really matters because we'll be planning our trades based on the most recent price action, this is where I would be concerned because yes, we've got a lower low, yes, we've got a lower high. However, those candles have become quite big in relation to the ones around it. So this is also the thing when you pick a trend to join, you also want to pick a strong trend to join. Okay, one that has moved very sharply, doesn't exhibit steady selling pressure. We're looking for steadiness because it's predictable, right? One that is also quite close to a historical low is worrying as well because while it can fall lower, the probability of it doing so in that time frame is lower as well because all of the momentum has kind of happened before, especially with these sharp drops to the downside, you know what I mean. I could have gone in on a short trade, yes, and joined the trend. However, as you will see when you talk about the trading strategies in part 4, you want to join it at the soonest possible point of it pulling back. And right here, the pullback's already happened at this high, and it's now continued. So the movement's already happened. I'm not going to chase it. Long story short. All right, yeah. So trend-wise, downtrend, you guys are right. Let's have a look at an example of an uptrend now. Did everyone follow that? Follow that part? It's a little bit more helpful when you think of pullbacks when you add on the moving averages. All right, today I just want you to look at trends, but with moving averages, we talk about the sell zone, which is a point of balance shown by those moving averages, and it gives you an added confirmation, just more probability that that's a good place to join the downtrend. All right, so I'll take this opportunity to quickly answer the question. There's a question about moving averages. So what's a good period to use for currency trading? Yes, you can use the 20 and 50. Generally, I have 4 out there. I have the 10, 20, 50, and 200 because they just show me what the short-term, medium-term, and long-term averages are. So 10, 20, 50, 200. You will be covering moving averages in part 2 of Forward Thinking Traders. Okay? All right, let's go and look at the Euro USD now. Okay, so what is it telling us? If we start from the 15-minute chart, what is this chart telling us? First of all, optimal price structure. Are there gaps? Okay, good. There are no gaps. There is a candle with a very long tail though. So it tails in with a very small body, showing a lot of indecision. But overall, it's still okay. We're looking at potentially a trade to the long side. Why do I say that? It's simply because you have a low here, and there was a clue because that market made a higher high, higher than this high, okay, higher high, and it's been confirmed by making a higher low. All right, in relation to that low, higher low. So yes, this is a confirmed uptrend. However, is this a good point to buy? Remember, we'll be buying at the printing candle here. without going into too many technical indicators that you are going to learn in the later part of the course, I do think that's a good place to buy because it's just broken through the previous high. Now I can see there's convergence as well, or maybe a little bit of divergence here. But I do have a place where I can put my stop loss that is still reasonable. It's 20 pips away. So that potentially could be a good uptrend. Sorry, uptrade. Looking at a higher time frame. Aha! So this is where you see the confirmation across multiple time frames can help you. Right now what we're seeing on the next time frame up is that it is not in a clear uptrend. It's actually sort of just hanging around this area. And again, it's a historic resistance area. You can see prices previously have come up near it and not broken past through. So it is unlikely that even if we buy into that trend, on the previous chart it looked really promising, I would be a bit concerned because generally if you've got a resistance level that's been tested and not broken, it can be hard to say whether or not it'll manage to break it on this try. This could be a good place to put a trade based on the breakout strategy, which I'm also conscious that you haven't learned, but this is where trend analysis on a higher time frame can just give you some ideas, which may not be apparent on the trigger chart itself. So yes, it does look like that on this market we wouldn't be following the trend flow strategy, but just seeing that it's an uptrend on the low time frames and then identifying a flat level on the 1 hour chart probably leads me to think that a better trade will be to get in on the breakout of this level with a tight stop loss in the direction of an increase. Okay, don't worry if you didn't follow that. It's just me going a little bit ahead of the market tonight. We've got a little bit more time, so if you do have questions, please send them my way. But I want to take you through just all the different markets to try and spot trends because that was the number one thing on our agenda tonight. Okay. Okay. So you can look at trends really, really quickly. For me, being a medium-term trader, I generally start looking at the 1 hour chart. If I do see something that makes me think, oh, it could be a momentum breakout, I'll either go lower or higher. Okay, so even on the 1 hour chart, doesn't look like it's promising. We don't know whether it's up or down. I'll go next. A USG, Euro Aussie dollar. Again, we've already looked at this chart just now. It's not a clear uptrend. It would have to break through this level quite convincingly and then make a higher low before I'd be interested in it. Nope, not a clear uptrend or a downtrend. Potentially an uptrend. Good place to join, maybe. We'd have to look at the other indicators to see what that says. But yeah, remember the turnaround points that we learned. Okay, so we had a bit of a downtrend here. The clue that it was going up was when it made a higher high. Confirm when it made a higher low. Now it's pushing through another higher high. Okay, so this is an example of an uptrend. Can you see that, guys? Was that clear? I'll run through it again. We had a downtrend. Remember, we get a clue as to an uptrend when we have a higher high. Confirm when we make a higher low. And now we're tracking in a higher high territory. All right? So this is an example of a young uptrend just starting. But whether you take a trade depends on other technical factors as well. So looking at the next time frame up, whether there's anything in the way of that. I look at 2 time frames up normally, and then I go back to that chart I was looking at, and then I also run through risk reward. So if I do buy into this trade, where am I going to put my stop? Okay, I have to put my stop here. It's about 10 pips. Yep. And what position size I would take. You will learn this when you get to part 4, but this is an example of an uptrend. Good. And USD, not great. That's a very indecisive candle there, not a higher high. You get an idea of how quickly we can do this, right? Not a trend that is a misleading downtrend because it's a high, not making a lower high that's a higher high and lower, but it's confused. It's not quite clear yet. Haven't got the clue for the uptrend because we've got a low. Yes, we got the clue in terms of a high high, but that has made a lower low again, so it's it's not great. Nope, needs to be confirmed. The higher low. Very erratic. This is an example of that sharp downtrend. Yeah, it does look promising in terms of downtrend, but for the factors I explained just now, you wouldn't be looking to short it. It might not be profitable because it's, there's no logical place to put your stop loss as well. But yeah, good spotting. That is a downtrend. Yep, remember when we are looking for a downtrend continuation, it needs to make a lower low than the one previously for it to be confirmed as a downtrend. Okay, this one's a bit erratic because I would have expected it to continue higher, but it does not look like it's going to go there because it's making all of these very bearish candles. Okay, so we've got about a minute left. I just want to check in and see whether you have got any questions. If we don't, then I just want to say thanks for joining the session and quickly remind you of the next part of Forward Thinking Traders. So that was part 1, and what we are going to do next will be to talk about price action mastery. So in part 2 we're going to talk about support and resistance levels, candlestick patterns and combining them with moving averages. Part 3 you're looking at putting the different instruments together and understand the bigger picture. So that's convergence between price and indicators, looking at divergence as well. And in part 4, we'll put all of that together and show you how it combines to make the trend flow strategy as well as the momentum breakout strategy. So like I said, those are different recipes that you can use for market scenarios in order to trade, and you will know how at that point in time to position size and control your risk. All right, so that's me tonight. I will stick around for questions. And yeah, if you have any feedback, I do appreciate you telling me as we go along. But if you do have any feedback about the course content, for example, if you thought that was maybe a bit too simple or too technical, then do let me know as well so we can make changes and keep improving. Okay, so thanks very much for joining us. Did have a very good time and your questions were great. try and jump on FX Trade yourself and pick those trends, and certainly take screenshots and keep records if that would be helpful for you. All right. Sante, the next class remains rescheduled. I think it's on at the same time, 7 p.m. your time. It may or may not be me taking it, but whoever takes it will be a person who trades as well. So you can definitely ask them the same types of questions that you have asked me. Okay. All right. Thank you, everyone. Have a good night.